Hello and welcome. I'm Ben. I'm a finance professor, and today we're talking about market timing. Market timing in the stock market. There are a lot of people who, when the market tanks, they get nervous and they pull their money out. This is the worst time to pull your money out. This is when stocks are the cheapest. This is when you should be putting your money in. You want to sell when things are overvalued, not when they're undervalued. I think sometimes people's intuition is exactly wrong as far as timing the market goes. And even though it makes you uncomfortable to hold your stocks after the market falls, that's the right play. That's the worst time to sell. If you ever want to sell, you should sell when prices are high, not when they're low. This video is going to have 3 items. First is some academic research by famous guys. Second is some beliefs by famous investors. And third is potential costs of getting market timing wrong. So first we start with academic research. The first paper is by William Sharpe. That name might sound familiar to you. Sharpe is the same Sharpe as in Sharpe ratio, which is a common measure used to measure risk-adjusted returns. It's returns minus the risk-free rate all over risk in the denominator. So it's how much return for each unit of risk. So in this paper, Professor Sharpe looks at 38 years of stock market data. Investors are allowed to do 2 things at the beginning of the year. If they think the market's going to go up, they can go into equities. If they think the market's going to go down, they can stay in cash. So they can time the market once a year. And he found that you only have to time the market right 83% of the time for it to be a profitable strategy. I don't know. That seems extremely unlikely to time the market right 83% of the time. All right. The second paper is by Cam Harvey. You may not know him, but you know of him. If you've ever heard of using the inverted yield curve to predict recessions, that's from Cam Harvey's PhD dissertation. So you may not know the person specifically, but you know his work. So in Cam Harvey's paper, Harvey looks at 326 market timing newsletters, and what these newsletters do is at the beginning of every month they can tell you to increase your equity weight if they believe the market's going to go higher, or decrease your equity weight and sort of switch into cash if they believe the market's going to go lower. They looked at 12 years of stock market data between 83 and 95, and the paper concludes newsletters do not possess any special information about the future direction of the market. So both papers find the same thing. It's very hard to time the market. So that's the first part of the video. That's the academic research. Next, we talk about famous investors' beliefs about market timing. First, we have a quote by the creator of the index fund and the founder of Vanguard, John Bogle. He says, "After nearly 50 years in the business, I do not know of anybody who is able to time the market consistently and successfully. I don't even know of anybody who knows anybody who is able to time the market consistently and successfully." Next is a quote by Malcolm Forbes. "The only way to make money with a market timing newsletter is to sell one." Next is a quote by Ben Graham. He was Warren Buffett's mentor. "If I have noticed anything over the last 60 years on Wall Street, it is that people do not succeed in forecasting what's going to happen in the stock market." Next, after receiving his Nobel Prize, CNBC asked Danny Kahneman if he had any investment tips. His advice was buy and hold. The last market timing quote is by Warren Buffett. He said, "I never have the faintest idea what the stock market is going to do in the next 6 months, the next year, the next 2 years." Those are market timing beliefs from famous investors. Last, I have worst case outcomes of getting market timing wrong. So let's say you invest $10,000 on January 1st of 1990 and you hold it for 30 years until the last day of December of 2020. If you invest $10,000 on January 1st of 1990, on December 31st of 2020, so 30 years later, you'd have more than twice as much money. You'd have $20,451. Now let's say you try and time the market, but you missed the one best day in the 30-year period. Your $20,000 would turn into $18,329. So you'd be 10% worse off missing just one day. Now let's say you missed the best 5 days over that 30-year period. How much worse off would you be? Your $20,000 now drops to $12,917. So if you missed the best 5 days, you're 37% worse off. Next, let's say you missed the best 15 days. Now your 20,000 becomes 7,080. So you lose almost 2/3 of the potential wealth if you missed the best 15 days. You're 65% worse. And if you were really unlucky and you missed the 25 best days over the 30-year period, your 20,000 becomes $4,376. So in the very worst case where you're awful at timing the market, you can lose a significant amount of your wealth by just getting it wrong on some inopportune times. The returns that I just shared with you, these potential costs, they're not because I cherry-picked 1990. If you look back at 80 or you start at 2000, everything's the same. It's not, I didn't cherry pick the date. I'll put links to the papers in the description below. Hopefully this video has convinced you that trying to time the market is a fool's game. Thank you very much for watching. If you thought the video was valuable, please click the like button below, and I'll see you guys in the next video.